Hi everyone, this is Dr. Tishta Bachoo, and today we have a new topic which is the distribution waterfall. If you work in the fund administration or fund accounting, you've definitely heard of the term waterfall. But in practice, this is one of the most misunderstood concepts in private funds. A waterfall, we are going to have a look at it in details. I'll go through it step by step and also do a simple example with you, just to explain to you how it works in real scenario, basically at work. Okay, so what is a waterfall? A waterfall simply explains how cash is distributed, to whom it is distributed, and in what order between investors and the fund manager. The fund manager, you will notice it is changed interchangeably with the term general partner or GP. So basically, when you have a waterfall, when you are doing a distribution, you would usually distribute your profit between your investors or LPs and also the general partner or the GP. In this video, I'll explain the private equity and the private debt waterfall step by step using a simple numerical example from a Luxembourg fund accounting perspective. But before that, we need to understand why waterfall matters. In Luxembourg, waterfall matter because they directly affect investor distributions and the reporting, the carried interest, audit reviews, and client questions on NAV and performance of the fund. As fund administrators, we are not deciding the waterfall, but we are responsible for applying it exactly as per the limited partnership agreement, also known as the LPA, which is the legal document of the fund. Okay, you'll see in the LPA, you need, when you're doing a waterfall, a distribution, you need to have it very handy with you because it has got all the rates, all the important details in the LPA. And any small mistake that you do here can have very big consequences. And the last thing you will want to have is a messy investor reporting, and you don't want to deal with investors if you have done a mistake. Okay, so you need to be very, very, very careful. Right, so I'll just very quickly go through the step by step of how do we do a waterfall, and then we'll straight away tackle a question. One, to carry out a waterfall, we need to repay back to investors. Whatever money they have put in the fund, we need to repay back. If they have, for example, we have, let's say, 15 investors who have brought in capital, the first thing when we sell our asset, when we have enough, we have generated enough cash, we need to distribute it to the investors and the GP. The first people who gets the money is the investors. They get everything that they invested into the fund. Okay, now this is not a profit sharing. We are not sharing any profit, we are not sharing any carried interest yet. They will only get 100% back their capital, not a euro less, not a euro more. What does it mean for accountants? It means that when we are paying back the capital that the LPs brought into the fund, it also means that we need to reduce the capital account. So whatever capital account they have into the fund, it will be reduced. In Luxembourg, private equity funds, this step is always applied first. Okay, notes for accountants and administrators, we are not carrying out any profit sharing, we are not carrying out any carried interest, we are only reducing the LP's account. Okay, now step two, we need to pay preferred return. The rule is the LPs must receive their preferred return before we pay anything to the general partner. Remember, waterfall really means allocating the profits between LPs and GPs. Now, who gets it first? Both will have to get it, but who gets it first, who has the priority, is the LP. So LPs must receive their preferred return before the GP earns anything. How do we know how much the LPs should receive? Is we know the rate of that return, the preferred return rate, also known as the hurdle rate or the IRR rate. You will get that rate in the LPA. Very commonly in Luxembourg, we talk about IRR 8%, 10%, 12%. Most common, it is 10% IRR, but it all depends. It can vary, but you need to check your LPA. Okay, very important point for accountants now. Preferred return again is not an interest. It is a performance threshold which is calculated on the timing of cash flows. Again, the step 2, it is a very or most audit sensitive area in Luxembourgish funds. I will show you how to use these highlighted. You would see in the previous slide as well. I highlighted this line in yellow. It's because if you're doing the calculation of the waterfall on Excel, this will be very, very helpful. How you calculate the preferred return paid. Okay, I'll do it on Excel and on paper as well, so you can have a look. Okay, now step 3 is the GP catch-up, which is again a very important part. So step 3, we need to now distribute it to the GP as well. Okay, so after the preferred return is met, we move to the GP catch-up. Here, the fund manager receives distribution until they reach their agreed share of profits. Okay, now what it means is we need to know what is the carried interest rate. How do we know that? Again, we are going to consult the limited partnership agreement, the LPA. In the LPA, we will be given the carried interest rate. Usually it is 20%, it can be 15%, so also this rate varies. So the fund manager, the GP, will receive the distribution to a maximum of 20% or to a maximum of the carried interest rate. This step exists to ensure that the GP ultimately receives the carried interest percentage which is agreed in the LPA. Again, the GP do not work for free. Of course, they are doing all the work, they are managing the fund, etc., because they need to be remunerated. Okay, so how do we calculate the GP catch-up? We need to calculate the profit. How do we get the profit? It is the total distribution, that is the exit price, minus everything that we have paid to the investors, the capital that they contributed, and now we are reimbursing them. So by doing this, we are going to get the profit, and the GP gets a percentage of that profit. So the GP will get 20% of the profit. Okay, again, highlighted in yellow, this is your formula to calculate the same thing on Excel. From an admin and accounting perspective now, the calculation must be very, very precise because this is a risky part, okay? If you do not get the percentage right, or if you do not get the total profit right, everything will go wrong. And from this step, everything follows, everything is linked. If this step is wrong, the fourth step will be wrong, and it's going to be messy. Moving on to step 4, which is the carried interest split now. This is the final step. This is where you are going to allocate the remaining profits between the LPs and the GP. So if you have been following, you would notice in step 1, we only had the distribution and the contribution, and we calculated the profit, right? Then the profit, out of the profit, we paid preferred return. Out of the profit, we pay a GP return. Now we are going to see if we have anything left. If we have anything left from the profit, even this remaining amount needs to be distributed accordingly. Okay, we keep distributing them until they fall to 0. That's why we call it a waterfall. Because whatever we have, we need to keep distributing. If something is left, we need to distribute again between these rate, between the rate of 80-20. Okay, here it is. 80-20. Now, from where do I get this 80-20? Usually in the LPA, it will tell you the carried interest rate is 20%. So automatically the LP rate will be 80%. If it says 15% is the carried interest, then I know the LP will be entitled for the remaining. So it's going to be 85%. If in the LPA it says it's 10% for the carried interest, it means it's 90% for the LPs. It is very usual, okay? The remaining, it's 1 minus the carried interest basically for the LPs. This is how I get the ratio. Okay, so step 4, carried interest means whatever profit is remain, now we are going to allocate them accordingly between the investors and the GP. Okay.
Let's walk through a real private equity waterfall calculation, step by step, exactly how you would see it in Excel while working on a Luxembourg fund. So here in this example, we are going to use very simple numbers, but the logic is the same whether you're dealing with a small fund or a multi-billionaire euro structure. This one is a European style waterfall, which is the most common in Luxembourg. So we'll just start with the inputs. Here you have the LP contribution, which is at 100 million euros. LP contribution, again, you might have 15 LPs, each one of them have contributed to something, and the total that they've contributed is 100 million euros. This is the exit, which means this is the price that you've got over distributions that you have generated from selling an asset. Okay, and this is the amount that you have now to allocate and to distribute. This is the hurdle rate, 10%, which is also known as the preferred return rate over IRR rate. IRR rate, and it is usually found in a limited partner agreement, LPA, for it's the legal document of an SCSP or partnership. The carried interest, it's at 20%. Usually it's at 15%, 18%, 20%. It depends on the fund, and it depends on, you know, the decision of the fund managers. So the carried interest is at 20%. Again, this one, you will get it in the LPA. Okay, so whenever you have to do a waterfall, you need to have the LPA handy because you need to check all these percentages. Okay, now, so these are the inputs. As I've already explained, what is the contribution, distribution, etc. Now, let's do it step by step. Step one, okay, step one, we'll try to do it this way so you can see. Step one, we are going to do the return of capital. Okay, return of capital means the investors must receive back their 100% of the capital they contributed before any profits is shared. So here we take the total distribution of 100. So exit is also known as the distribution. Okay, so the total distribution here is 150. Distribution is 150 million euros. Okay, and from this we need to return everything, 100% of what the LPs contributed into the fund, which is 100 million. So here we are going to less all the LPs contribution, which is 100 million euros. Okay, this is the first step. We need to pay back everything that the LPs contributed. Okay, after this step, how much do we have left? Left we have 50 million euros. 50 million euros remaining. Okay, from an accounting perspective, this is simply a reduction of investor capital accounts, which means they contributed 100 million euros. Now that we are refunding, we are paying them back, it also means that they will no more have a capital account in the fund. We are returning the money, so they will not hold anything in the fund anymore. Okay, and we are not, remember here, we are not allocating any profit here. Okay, we are only reimbursing the amount that they put in the fund. They put in 100 million. We are removing the 100 million. We are reducing their capital accounts by 100 million euros. From an accounting perspective, it simply means we are reducing. So here, reducing of capital accounts. Okay, there's no profit allocation, no carried interest here. Okay, moving on. Next step 2, we will do the preferred return. Okay, next we apply the preferred return, also called as hurdle. Okay, you will see we have the hurdle rate as 10%. Now, what we do is the hurdle rate is 10% of the LP's contribution, which means 10% of the 100 million, which gives us 10 million euros. Okay, hurdle rate, it's 10%. So this is the preferred return. The preferred return, therefore, is 10 million euros. Okay, now this again will be paid to LPs at the stage. This also is being paid to LP. LPs. This also is being paid to LPs. Now, we made a profit of 50 million euros after we have already paid LPs their contribution amount. From this, now we need to pay 10 million euros to LPs. Okay, so this means that we have remaining cash of 50 million minus 10 million. It gives us 40 million. Okay. Another important point for accountants at this stage is that this preferred return, it is not interest. Okay, this is, okay, I'll write it here, not interest. Okay, this is not an interest being paid. This is a preferred return. It is a performance threshold which is calculated on the timing of cash flows, and this unfortunately or fortunately it is very closely monitored by the auditors in Luxembourg. Okay, so again, just a quick recap. Preferred return, you take your hurdle rate, which is given in your LPA. Here in this example, it is at 10%. You multiply it by the total contribution of the LPs. It gives you 10 million euros. I will explain to you later how do you do it on Excel as well. But simple calculation, mathematical calculation is this. Right. Now we'll look at step 3. Step 3 now, we will do the general partner, the GP. This is where most of the confusion happens. We'll try to tackle it, slowly. So, to be able to calculate or to do this step, which is the GP catch-up, we need to calculate the profit of the fund, total profit of the fund. We have already calculated it. Total profit of the fund is here. This is the total profit of the fund. Why it's the total profit of the fund? It is because in the fund, we had the distribution. So basically this is sales, exit price 150. Then we have already paid out all the LPs their amount which they put in the business, which they put in the fund. We are left with 50 million euros, which is the profit. Now, the GP is entitled of a small amount of this profit. Okay, we need to calculate this one first. Okay, now here the profit is 50 million euros. The GP is entitled to this 20%, the carried interest. Okay, the GP therefore will get 20% of 50 million euros, which is 10 million euros. Okay, so the GP catch up, the GP is entitled to the maximum of the carried interest rate. Okay, this is their target, also known as target. Okay, so now you made a profit of 50 million euros, out of which you need to pay preferred return of 10 million to the LPs, GP catch up of 10 million to the GP. Okay, what is your remaining cash balance? You have already paid 100 million, then you were left with 50 million. Now you have paid 10 million to LPs. Now you're paying 10 million to the GP. How much are you left is 50 minus 10 minus 10. 50 minus 10 minus 10, it is 30 million euros. This is your remaining balance. Okay. Now this step, it is very, very critical, because if you mess up this part, then the next step will go all wrong. Okay, because it's a flow. Can you see? It's a flow. We are using the same 50 million euros to calculate the GP catch-up. Now we are going to calculate the residual split, which means how much will the LP eventually get and how much more the GP can get. Okay, and this is another part where accountants need to be careful, because auditors are going to very much scrutinize every part of it. The main focus is heavily on this part as well. Okay, so moving on now, step 4, which is the residual split. Okay, now the residual split is the final step. And here in this step, we need to allocate or apportion this amount. Okay, and this amount is split according to the carried interest ratio. If we go up, how much is the carried interest ratio? It's 20%. So 20% means the GP is entitled to get the 20% of the carried interest. Okay, so here we will see the remaining 30 million euros will need to be split between LPs and the GPs. This is why it's called waterfall. It's step by step. Who gets it first? It's the LPs get it first. Who gets it second? The preferred return also goes to the LPs. Who gets it third? The GP gets the catch-up. Who gets it then? Whatever is remaining, because what we are doing is we are sharing the 150. How do we share it? We reimburse the capital. Then we pay out preferred return. Then we pay out the GP catch-up, because at the end of the day, even the GP has worked for the fund, right? For the benefit of the fund. So they get the catch-up. Then here, whatever is remaining, we cannot use it. We cannot throw it away. We cannot put it in the bank. We need to keep sharing, apportioning it. So finally, what we will do is apportion the 30 million euros between the GP and the LPs. The GP, we know they will get 20% because it's given in the LPA. If GP is getting 20% of 30 million, 20% of 30 million, which means 6 million euros, how much does the LP get? The difference. 1 minus 20% is 80%. 80% of 30 million euros is 24 million euros. Okay, this we go to the LP, this part we go to the GP. If I ask you, how much will the LP get in total, LPs get in total, and how much does the GP get in total? 100 million goes to whom? LP. 100 million LP. Preferred return goes to whom? 10 million, again LP. 100, 10. What else does the LP get? Does the LP get the GP catch-up? No, that's for GP. Does the LP get anything from the residual? Yes, it is. The LP is getting 24 million. So here, LP is getting 100 plus 10 plus 24. So LP is getting 100 plus 10 plus 24, which is 134 million. And how much is the GP getting? GP is getting 10 million of the GP catch-up and 6 million of the residual split. So 10 plus 6 is equal to 16 million. Right, we are done. This is how it is distributed. Now let's do a check. 134 plus 16 is equivalent to 150 million. Have we distributed all the amount that we sold the asset for? 150 million, 150 million, which means we are good. The 150 million here has properly been allocated between LPs and GPs. And this is very important for you to do a control check. Okay, this control check needs to be done by accountants and the auditors as well, right? So you can also interpret it in this way. You made a profit of 50 million euros, out of which the GP is paid 16 million, and then the remaining goes to the LPs along with their return on capital, their 100 million.
You have already done your control check. You have noticed that the total profit of 50 million euros have been allocated to the GP and the LP. The GP eventually gets 16 million euros in total, and the LP gets over capital they contributed plus the profit sharing as well. Now, you might think that the GP is getting more than 20% of the distribution, like 16 million over 50 million is literally more than 20% of the distribution. But in a sense, it represents only 20% of the total profits once the hurdle mechanics are applied. Okay, so this is exactly why actually the catch-up exists. This is why we need to pay the GP something. Okay, so the same example, if you had done it on Excel, it would look like this. So this is just a snippet from Excel. Again, to capital contribution, 100 million, distribution, 150 million, hurdle rate 10%, carried interest rate 20%, preferred return is 10% of the capital contribution. I have already mentioned the remarks as well. Where do you get these from? So the return of capital is we are paying back this 100 million first. Then we are left with a profit of 50 million, 150 minus 100, which is 50 million. From the 50 million now, you also need to pay the preferred return allocation. This is the formula on Excel. Okay, so is equal to min bracket remaining cash, which is 50 million, comma, preferred return which is 10 million. Okay, so you know exactly what would be the allocated preferred return. Then the remaining cash after paying the preferred return to LPs would be 40 million. The GP catch-up, GP first gets the maximum of the carried interest. It is also 20% of the profit. So 20%, because the carried interest rate is 20%. How much is the profit? The profit is 15 million. So 20% of 50 million, the GP also would get 10 million euros. Okay, now we are paying preferred return 10 million, GP catch up 10 million. We had a profit of 50 million. How much do we have left? Is 30 million. Now this is the 30 million which you need to distribute between LP and the GP as a residual amount. Okay, GP we know is a 20% carried interest rate, so 20% of 30 million is 6 million, and then the remaining 80% we go to the LPs. In total, how much the LP would get? It is their full 100 million amount, their capital, plus the preferred return allocation of 10 million and the 24 million LP residual, which is a total of 134 million, while the GP would get 6 million plus the 10 million the GP catch up, which is 16 million. Okay, as I said earlier, it would seem like if you just take GP, if you take the GP amount, 16 million that they are getting on the profit on the 15 million, it would seem that they are getting a 32%, but that's wrong to assume because actually what they are getting is the 30 million, this one. Okay, so this is the remaining cash after all the catch up. So they are actually getting 20% of the amount. A little bit further on the Luxembourg funds waterfall. In Luxembourg, most funds use the European style waterfall. Now, we do have another waterfall as well, which is most commonly used for funds in the US. So it's called an American waterfall. Well, it is used in Luxembourg as well, but very, very rarely. Most of the time, we would follow the European style waterfall. European style waterfall means the carry is calculated based on an overall fund performance, so basically on the whole fund, whereas the American waterfall is calculated deal by deal. And also, it is important to note that investors must receive back all capital and full preferred return before any carry is paid. While in an American waterfall, because it is done deal by deal, this allows earlier carry to be paid. But also, this one you need to be very cautious because this type of waterfall it includes some clawback clauses, which again is found in an LPA, but it's just a different you know place to look at it. It's not really the carried interest rate or the hurdle rate. You need to read very much in details the clawback clauses. As I said, most of the waterfalls that you would be doing if you are in Luxembourg or Malta or EU jurisdiction would be the European waterfalls because they use a more conservative approach and it's most commonly used in Luxembourg. Now, very briefly, private debt waterfall. Um, Yeah. So private debt waterfalls are much simpler. So basically what we've done in this example, so it's supposed to be more tricky, but private debt waterfall is very simple. What happens here, typically cash is distributed in the order. So we need to deduct fees and expenses first, then pay over interest to investors, then pay the principal repayment to investors, then also deduct over performance fees and so on. If there's anything, again, your Bible would be the LPA. It will tell you which order and what needs to be deducted, what needs to be paid out, etc., before cash is distributed. The key difference is this: the private debt waterfalls are income first, while the private equity waterfalls are exit driven. As I said, private debt is simpler, so you can imagine it is simpler, it is more easier to audit as well. Okay. Here I have given you a side-to-side waterfall comparison of what you do in a private equity and a private debt. This is something that you can have a look at in your own timing. We'll move on with the key takeaway. So please remember the key points here. A waterfall does not change how much the fund makes. It actually determines who get paid when and why. Private equity waterfalls allocate profits, whereas private debt waterfalls allocate cash flows. If you work in the fund administration or fund accounting in Luxembourg, understanding this logic, so if you're really into the key takeaway of tonight, it's going to be fairly easier for you to run through a waterfall calculation. Okay, so with this, we come to an end.
So let me know if you have any other topic you want me to cover, especially concerning the fund administration, fund accounting in Luxembourg. I'll be very happy to do so. So please shoot me an email or comment on the video below, or you can contact me via LinkedIn. So please don't hesitate to do that. Thank you very much. Bye.